Why are markets selling off today? Is it because tomorrow is the Jackson Hole Symposium and people are just worried that J-Pow's going to talk at 10 a.m.? Or is it that maybe we already got the seeds planted of what to expect for J-Pow's speech tomorrow, and markets are starting to price in what's coming down the pike? In my opinion, it's the latter, the second part. And let's talk about what we just learned and why it's so important going forward. Keep in mind, if we got some big cuts here from J-Pow and some really good news from J-Pow, I might actually be interested in going more bullish than I am now. Yeah, that'd be a flip, because I actually think they would then be able to avoid a recession. Unfortunately, the Fed appears to be positioning themselves to do the opposite of this, and it's really bad. Let's talk about both those things in this video. I do want to mention that if you are trading, I found a lot better liquidity in these options right here on screen. If you're day trading, I used to love Tesla and Enphase, but I found when I was trading larger option sets, the liquidity was bad. So when you were exiting, you were getting these really nasty spreads. However, if you go even on 0 days on Qs, very, very risky, but for day trading, the liquidity is excellent. The orders just fill. And here's an example of one I was playing this morning. 482, picked up some contracts on a smaller order for $2.40 times 50 contracts, so times 50 times 100. And I was able to sell those for nearly a double at 420. Those did end up popping up even more after I sold them. Of course, sometimes that happens, but that's okay. Locked in a profit. We were talking to course members about that this morning, and we've got a really cool outline. So if you want to join, see the trading rules, and get some perspective on what's going on there, make sure to use that J-Hole coupon code, Jackson Hole, expiring tomorrow. Okay, so here's what's going on. Jerome Powell's speech is at 10 a.m. tomorrow. But this morning we had Fed Harker mention that he's on board with a September cut if data keeps coming in as expected. But he thinks the right answer is to go with a slow, methodical approach to cuts. He says this is an expectation game, and they're really worried about shelter inflation. That's the big one they're watching, and they're concerned that there could be a boost in shelter inflation as they slowly start reducing interest rates. They're seeing the mortgage business is starting to come back alive. More people are writing mortgages. They specifically talked about the mortgage industry, by the way, because the long end of the yield curve is coming down, and they are wanting to slowly see shelter prices consistently come down, but are concerned they're going to hit a floor, pop up again, and we'll get a second wave of inflation. And so because of that, even though they think it's time to start, and they're pretty much guaranteeing us, which we saw in the minutes yesterday anyway that we covered on the Meet Kevin Live channel. If you're not there yet, subscribe to Meet Kevin Live. We do a free market open every day the market is open, and sometimes we'll even do market close or like minutes or something less critical for a main video. But there were a few things that in those minutes that we're going to talk about in just a moment as well that were a pretty big deal. But sticking to what Harker said is actually really important, because he's saying we're still worried about a portion of inflation. And this is where we have to remember the Federal Reserve is more afraid of inflation than they're afraid of a recession. Think about that for a moment. If you have a recession, the Federal Reserve will come in at the bottom, bail out everything, and swoop in like the hero. Boom, Federal Reserve credibility up. If they reignite inflation, Federal Reserve credibility goes in the toilet and they lose even more control. So if they had to pick, would you rather have more inflation or would you rather have a recession? They would rather have a recession every day of the week. They've got plenty of room to deal with a recession, but that's actually bearish. See, after this discussion from Harker this morning and Collins, which I'll talk about in just a moment, we actually started seeing the market unprice the potential for a 50 basis point cut in September. We're going to get a rate cut, but we're probably going to get 25, 25, 25. The problem is it's going to be too slow. In my opinion, in order to avoid a recession, the Federal Reserve needs to move substantially faster. Unemployment is weakening substantially worse than they suspect, and I think unemployment numbers, like unemployment claims, are worthless because they're very lagging, and job openings, I think a good portion of those are probably not real job openings because now people just leave listings posted on the job recruiting websites and they're not really motivated to take them down because they forget about them. And then you have, the companies, the job listing websites that aren't motivated to tell you to take them down because, frankly, why would you if they keep making money off your listing? So it's really easy for people to kind of get stuck in leaving job openings posted, but they're actually probably dead postings, which is bad. We don't want that. So I think the Federal Reserve is using pretty lagging data here. And unfortunately, we're probably going to see the Federal Reserve move too slowly here. But their commentary is reiterating that they're committed to moving slowly. And I actually find this bearish. And I think this is why the market is selling off today. You look at the Qs down a little more than 1%. You got Nvidia down almost 3%. Tesla's down somewhere in that 4% range. Yeah, look at that, almost 420 down, 420 basis points. Crazy. But the big thing that you have to remember is a Fed that moves too slow creates a jobless recession. This is actually a very different kind of recession than what was expected in January of 2022. See, in Jan 22, we're like, okay, we're going to have a year-over-year technical recession because 2021 was bonkers and everything was great. And things will normalize. Everybody still have their job and their money. When things stabilize, people can go back to buying Teslas because they have the excess money, they have the jobs, and everything will be okay. It'll be sort of a small recession. Well, now here we are in August 24, rates are obscenely high. Companies that are interest rate sensitive, like Tesla, are either forced to manufacture less vehicles, which Tesla is doing, not growing like they used to, or substantially buy down interest rates, or both. And now all of a sudden, a 25 basis point cut isn't really going to pull forward any kind of demand because you kind of already pulled forward demand to May, 0.99% offer for Tesla, so 25 basis points. Start of rate cut cycle won't actually matter. And the Q3, Q4 buyers are actually potentially more worried about losing their job now than they've previously have been. I mean, look at what Nick T was tweeting on X. He's arguing, hey, more people than ever before since the beginning of that survey data going back to 2014 are worried about losing their job. This is an environment where people are going to be interested in spending less money on larger purchases, especially monthly payment commitments that are going to beat them up if they end up losing their jobs and then they're squeezed into a corner at a high interest rate and don't have the ability to refinance lower because they've lost their job. This is a problem. So I think it's a big mistake to look at some of the data that the Fed is looking at, which is really lagging data, whether it's unemployment claims, or the job openings numbers, which I think are way too high, or the fact that unfortunately the Fed seems convinced that the historical long-term average of unemployment is 5.5%, and we're at 4.2, 4.3-ish. We actually have a lot of room to give the Fed a lot more unemployment. The problem with that is it means the Fed's going to go slower. And in the short term, that leads yields to spike. So you're actually going to see pain in like a move like a TLT, right? A 20, 30-year mortgage, treasury bond rather, not mortgage. You're going to see some pain there short term because the markets are like, oh, okay, Fed's going to go slower. Got it. Yields higher then. But the Fed's just going to do more damage by going slower. And so that'll likely, in my opinion, lead yields to have to come down even lower. So the longer they go 25 BPs, the deeper down they're going to have to move in the future. And so then you align what Collins said this morning. So Fed Collins said the job market is healthy despite revisions. Okay, well, that's not good. I don't think the jobs market is healthy. Now, maybe I'm wrong. I'm just a dude on the internet. But I'm not very happy about that, especially when we start seeing some of the deterioration that we're seeing that they should be paying attention to as well because it's literally in their Fed minutes. Take a look at this. I'll show you some of the Fed minute highlights I've got here. I'm going to move over to everybody's favorite microphone, although I think I shouldn't say perfected, but I've improved this microphone. So let's see what we got here. Delinquency rates on loans to small businesses remain slightly above pre-pandemic levels, so we're trending up now above pre-pandemic levels, not great. Credit quality in commercial real estate deteriorated further. Okay, that's not good for the small banks. Now add to that yields not coming down quickly enough to save the small banks. That's not great. And the average delinquency rate for loans in commercial mortgage-backed securities and non-performing commercial real estate loans at banks are both rising further. That's not great. Now, the area where things are okay, oh my gosh, what a surprise. Residential mortgages. If you're a course member, you know I've got a lot of opinions on how to invest around this. But anyway, delinquency rates on residential mortgages remain near pre-pandemic lows. Though consumer delinquency rates have increased, that would be on like personal loans, credit cards, and autos. Okay, this is not good. At the same time, they also argue that valuations remain elevated, not just for some real estate, but also broadly markets in general, which could be the stock market, for example. So when you combine these minutes with what the Fed is saying, you can't help yourself but be like, man, Fed, are you sure y'all not going fast enough here? You sure? And they're like, we just got to make sure we really killed the inflation demon. So anyway, Fed Collins says a gradual pace of cutting is likely appropriate. Again, this implies 25 basis points. That's why the market's red today, in my opinion. And she says we're not seeing a red flag in consumption data. But again, I think people forget that what happens first is CapEx spending slows. I was just reading data yesterday that's exactly what's starting to happen. I wonder if I can pull it up. But CapEx growth spending, just off memory, is starting to decline from, I want to say it was like a 45% growth down to like maybe 30 or 35% growth. It may have been this. Let me look at this here. It may have been this one from Barclays. Cautious outlooks mostly overshadowed decent Q2 earnings. Margins were resilient and capital returns were strong, but CapEx intentions softened. You got to remember, this is like, I can't remember exactly where it was in here, but that is one of the most important things to pay attention to when it comes to especially the AI plays, is what are people doing with capital expenditures? Because as soon as CapEx spending slows down, then you get layoffs, right? So then the consumer gets hit. So you got to get the order straight. CapEx spending down first. That's number one, CapEx spending down. Then people stop, then you get layoffs because CapEx spending down. Then you get consumers spending less money because they got laid off. Then you get recessionary earnings. And then only a few months after people get through their layoff period, after the warn notice has been filed, they've been laid off, and they actually file for unemployment, it's like 6 months down the road, then you see the unemployment claims go up, but then it's too late, then you're deep in the recession. So like, people keep telling me like, oh, but things over here are okay. Unemployment claims are fine. The consumer's still broadly okay. I understand, but it's the first thing is starting to crack. The companies get less optimistic. They start worrying about margin more. They lose their pricing power. Then they start laying off. And as we saw in the prior video that I made on this topic, as soon as those layoffs normalize, we're going to see that unemployment rate pop up very, very quickly because we're still below average on layoffs, which sounds like a good thing. But as soon as that normalizes, the unemployment rate will go, boop, oh, wow, it's up another 0.5 percentage point. That's not good. So you have to recognize the markets right now are probably saying, oh my gosh, the Fed's going to go slower than we think. Now we have to unprice rapid Fed rate cuts. That is short-term bearish, basically all stocks. And certainly then yields spike. And so like, a mortgage or a treasury exposure will get hurt today. I actually see that as a buy the dip opportunity on treasuries because I think that there's only one direction for treasury yields going forward. Of course, I could be wrong. I'll let you know what my trades are, though, obviously in the course member live stream and course member alert section. We've divided them now into 3 sections, day trades and swing trades under 90 days, 90 days to a year, and 1 year plus. So you can always kind of see where my current allocation is, and I'll kind of keep that updated. I think that's very useful. But anyway, make sure to check that out over at meetkevin.com before tomorrow. We're already within 24 hours of that price going up again. Okay, so that's my take. Why is the market falling today? The Fed. What's going to happen? The slower the Fed goes, the more damage they're going to cause, and the more down they're going to have to end up going on the neutral rate. That's my take. I think it's pretty self-explanatory, and I hate to say it, but I think that's what's going to end up happening. The slower the Fed moves, the greater the odds of recession. Thank you so much for watching. We'll see you in the next one. Goodbye and good luck.
These things that you told us here, I feel like nobody else knows about this. we'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than HouseHack, nor am I presently acting as a market maker. Make sure if you're considering investing in HouseHack to always read the PPM at househack.com.